Why I recently reduced my bonds from 40% to big fat goose egg. All right, so let's read this article. This is on Medium from Dave Shearer. Shearer. All right, so let's take about old Dave here. Let's see. And why many advisors will disagree. All right. So I haven't read this article. Let's read it together, shall we? Let's collaborate. Collaborate. And listen. All right, so here's VBMFX. Isn't that the bond, the Vanguard Mutual Bond Index? It's on a bull market in bond funds, most recent 10 years. All right. Gotcha. One of the favorite financial topics of this dateline, by the way, April 21st. One of the favorite financial topics of late are warnings about bonds in today's environment. Many experts in financial press believe we're at a coastal inflection point and are likely to enter a bear market for bonds. I've highlighted two examples in the next section. Forbes says, could 2021 be one of the worst years on record for bonds? All right. They noted that 10-year Treasury bonds were down over 4% in the first 2 months. It also points out the future concerns over rising inflation and the risk of investors moving from the safety of bonds to riskier assets, assuming continue. Okay, Ray Dalio, the largest hedge fund in the world, says, why in the world would you own bonds when the report graphs the cyclical nature of bond yield since 1900. He notes that bonds have been in a bull market for the past 40 years. Okay, what else? Since most investors and investment advisors have never been seriously stung by a price decline, this is a factor for potential bubble. All right. Ray believes a well-diversified portfolio of non-debt and non-dollar assets is preferable to traditional stocks and bonds. Non-dollar assets, right? Because cash is trash. Send me your trash. In 2019 April, 2 months before my 59th birthday, I changed my investment allocation to manage risk since retirement isn't too far in the future. Hey, big boy. I had 40% of the long-term bond index and 20% of the short-term bond index. Okay. Oh, he had 40% in the bonds, of which 50-50 was into those two funds, the short-term and long-term. They were buy and hold positions that would be rebalanced when any of my 5 asset classes were larger than 10% of target. Oh, it just sounds boring to me. Just rebalancing is just not. Maybe once every 5 years. The idea I got to rebalance on a regular basis. Now some people do it. I get it. I mean, I don't know a problem with that. I'm just too lazy. I don't want, because it doesn't do you anything. It literally, you rebalance from 60-40 to 55-45, whatever, from 70-30 to 60. It's just not going to make that much of a difference. Last year, I changed to a global tactical asset allocation model. Hey, I knew this was going to be in line with MedFavor. I said, that sounds like MedFavor, yeah. The GTAA incorporates a timing model for buying and selling asset classes. On average, 30% of the portfolio is in portfolio value. 30% of the value is in cash, waiting for buy signals. It confirmed a buy signal in Q4 2018 and provided for a sell signal in Q4 2020. So the question is, when was the buy-sell signal in Q4 2018? Was it in December or was it in October? Because that's, we had a 19.4% decline in Q4 2018. So when was the actual sell signal? Well, I guess he has it right here, buy signal. So that says right here. Okay. All right, there we go. So it looks like towards, I can't tell, that's November something. All right, so you missed the bottom, which is inherently. And then we had a sell signal in Q4 2020. All right, and I'm not sure what that is. This looks like October sometime, a sell signal in Q4 2020. Oh, that's on the long-term bonds. Okay. All right, one sec. Pablo! All right, so then as a result, I moved the 40% allocated bonds into cash. The recent price drop and amount of bond bashing in the most recent months confirmed my exit from bonds last year. Okay. All right. Oh, he's talking about me there. Okay. I found a certified financial planner. Oh, please don't call me that. Who's been YouTube videos to counter financial fear mongering for 7 years. I'm not going to call him out. It's me, Josh Scanlon. I generally preach common sense, stay the course. Advice can be helpful in many situations. He hopes I change my mind on bonds. I don't get what is my mind on bonds. This guy uses the Vanguard market to. All right, so okay, so there you go. So he said, yeah, he concluded show me any history of a bond fund that has consecutive down years. I don't know any, and I use the Vanguard Total Bond Index. I'd like to see it. All right, so there we go. Back to 1987, and I don't know any. And then if we even look at that bond, that not T. Rowe Price, Putnam, I think, had a bond that went back to 1955, and I don't recall any consecutive years of down markets. All right, so let's see, my man. All right, so that goes back to 1987. Use the Vanguard Total Bond Index, I believe. All right, well, the CFP, just call, yeah, you call me, I don't care. The CFP indicated that he could not guarantee bond index funds will continue in this manner. Let's take a look on the 10-year Treasury doing it right now. No one has any idea, man. It's nuts. Remember, the 10-year Treasury is based not on the Fed, is based on supply and demand. So there we go. Back to 1.552. So it's off from, it was at, what was the 10-year Treasury here? It was at 1.8 something, yeah, about 1.88, I guess, and then it's back to 1.552. So it's down 30 basis points roughly over the last, hell, freaking 3 weeks. Nuts. All right, so let's see what my man says here. My answer to his question that bond prices are related to debt cycles. Are they? Really? The easiest way to understand short and long-term debt cycles is to watch this first 20 minutes of the video, how the economic machine works. The long-term debt runs 75 to 100 years and is caused by human nature, greed, and fear. That doesn't, literally, that makes no sense, man. The capital markets, we don't have 75 and 100 years of cyclical stuff in the capital markets to say, I mean, think how absurd this is. The bond prices are related to long-term debt cycles. And he goes, the long-term debt cycle runs between 75 and 100 years. Huh? I mean, the Federal Reserve just came out in 1913, right? 1913. So we have basically 100 years of the Federal Reserve. So are we in the first, still in the first cycle or the second cycle? Either way, it's only two. There's no statistical relevance there. Whoa, Finnegan. Remember that long-term cycle lasts longer than active investing time frame of most individuals, of actually the capital markets themselves. The illustration of a 10-year Treasury rates illustrates most of the latest long-term debt cycles started with the rate increases in the late 1930s. Why do prices go down when rates rise? Rising interest rates cause bonds to fall. Rising interest rates cause bond to fall. All right. I download the monthly aggregate from the Federal Reserve Board and graph it. Okay. All right. I don't understand what we're saying here. This is actually kind of boring me, to be honest with you. So he's not answering. So we have a tracker, 2021 and 1987. We look, if you want to go back to the Putnam Fund in 1955, by all means, I think it's Putnam, or Franklin, I think it's Putnam though. By all means do that. I just frankly don't feel like it, but you certainly can. Prove me wrong that we've had more than consecutive years of a bond fund that's dropped twice. I mean, I don't know of any. If you can prove me wrong, that's great. I just don't know of any. All right, but it's pretty clear where trends are heading related to the long-term debt cycle. Although it's possible to predict when the bull market for bonds will end. All right, well, I'm at a loss here. All right, well, whatever. Yeah, all right, so the time to return, the financial planner is still recommending bonds. He and other financial planners are seeing a 40-year bull market in bonds and don't see an end since they aren't considering long-term debt. All right, that's just whatever. Look, people got to do what they got to do. This stuff bores me to death. It really does. If you're using a model to rebalance, look for buy signs. The 200-day moving average, fine. Go get the guy out of Richmond, not Ned Davis Research. There's a guy out of Richmond. I forgot what their names are. They're out of Richmond, not Davis Research. I forgot what they're called. I gotta think this through. Who's the point investment charting firm? I can't remember what they're called, man. I'm drawing a freaking big fat blank, and we used to have access to them when I was at Legg Mason, and a lot of people who were trying to prove their worth as the investment advisors were using these guys. I cannot believe I'm forgetting. It's not Ned Davis Research. It's I can't believe I forgot these guys. Oh, it drives me crazy. Anyway, this stuff bores me. All this stuff bores me, and the reason it bores me is because Finn. At the end of the day, I ultimately like the barbell approach. You have 4 years cash, literally, in Ginnie Mae fund, and then you have the rest in stocks. However, That's hard for people to get a lot of times, especially in 401k or whatnot, or an IRA. It's hard to implement. Now, as such, I said, just go to Wellesley. Wellesley, 35% stocks, 65% high quality corporate government bonds. We have a track record that goes back to 1973, very enviable for sure. Keep it safe. This whole tactical stuff just bores me to death. What we've got to do is protect the bottom line if you're that close to retirement. We can't afford a 2001 and 2, a 2007, 8 and 9, a 1973 and 1974. You can't afford that. And all the tactical stuff in the world, whatever. Do what you got to do. But I'm just sitting there thinking, man, the one thing that matters is making sure you don't get crunched when the cows come home to roost. Cows or the chicken? The chickens come home to roost. Because they're coming home, man. And that rooster is chasing them. And they're coming home. When those chickens come home to roost, as Jeremiah Wright said. And what it does, you don't want to be holding a wet bag. So protect the bottom line is first and foremost the most important thing you should do if you're within retirement spin distance. All right, we'll see you.